Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Considering stock market investing can feel overwhelming, especially when you're just starting out. You might be wondering how to even begin or if it's too risky for your hard-earned money. The good news is, with the right information, anyone can understand the basics and start building a solid financial future. This video will walk you through what the stock market is and why understanding it is key to growing your wealth. We're here to explain everything in simple terms, helping you feel confident about taking your first steps toward becoming an investor. Get ready to unlock the potential of the stock market for your financial goals. What exactly is the stock market and how does it work? The stock market might seem like a complex machine, filled with jargon and fast-paced trading. But at its core, it's a marketplace where pieces of companies are bought and sold. Understanding how it operates is your first step to making informed investment decisions. We'll break down what stocks are, where they're traded, and who participates in this dynamic environment. Defining stocks. More than just a piece of paper. When you buy a stock, you become a part owner of the company. It's not just a fancy certificate, it's a claim on a portion of the company's assets and earnings. There are two main types of stocks you'll encounter. Common stock. This is what most people think of when they hear stock. Common stockholders have voting rights in company decisions, like electing the board of directors. Their potential for returns is higher if the company grows, but they also face more risk if the company performs poorly. Preferred stock. This type usually doesn't come with voting rights. However, preferred stockholders typically receive fixed dividend payments before common stockholders do. In case of liquidation, preferred stockholders also get paid back before common stockholders. This makes preferred stock generally less volatile but also offers lower growth potential. The role of stock exchanges, where trading happens. Stock exchanges are simply organized marketplaces where stocks are bought and sold. Think of them like a farmer's market, but for company ownership. Two of the most well-known exchanges in the United States are New York Stock Exchange, NYSE. This is a physically based exchange, known for its trading floor and traditional auction style. NASDAQ. This is an electronic exchange, meaning all trading happens through computer networks. It's often home to many technology and growth companies. On these exchanges, stock prices are determined by supply and demand. If many people want to buy a particular stock and fewer people want to sell it, the price tends to go up. Conversely, if many want to sell and few want to buy, the price often drops. This constant interaction between buyers and sellers is what makes stock prices fluctuate throughout the day. Understanding market participants. Who's who in the stock market? The stock market is a vibrant ecosystem with various players. Each has a distinct role in how stocks are traded and prices are set. Key participants include individual investors. These are everyday people like you and me, investing their own money for personal financial goals. We often trade through online brokerage accounts. Institutional investors. These are large organizations handling vast sums of money. Examples include mutual funds, pension funds, and hedge funds. They often trade in much larger volumes than individual investors. Brokers. These professionals act as intermediaries between investors and the stock exchange. They execute buy and sell orders on behalf of their clients and provide investment advice. Market makers. These entities stand ready to buy or sell specific stocks, ensuring there's always a market for trading. They profit from the small difference between the bid and ask prices. Key concepts for beginner investors. Building your foundation. Starting your investment journey means understanding some basic ideas. These concepts will help you make smarter decisions and feel more confident about putting your money into the market. We'll cover how market sentiment works, why spreading out your investments is crucial, the link between risk and reward, and why thinking long-term can benefit you most. Bulls, bears, and market trends. Deciphering market sentiment. Have you heard people talk about bull or bear markets? These terms describe the general mood of investors. Understanding this mood helps you see where the market might be heading. Bull market. This is when stock prices are generally rising. Investors are feeling optimistic, confident that prices will continue to go up. Think of a bull charging forward with its horns up. In a bull market, companies often report strong earnings, and unemployment might be low. For example, after a new technology breakthrough makes many companies more profitable, you might see a bull market. Bear market. This is when stock prices are generally falling. Investors are pessimistic, believing prices will keep dropping. Imagine a bear swiping its paws downward. Bear markets often occur during economic slowdowns or recessions. For instance, if a major industry faces unexpected challenges, like a global health crisis, you could see a bear market. Investor sentiment can heavily influence these trends. If everyone feels good about the economy, they buy stocks, pushing prices higher. If fear or uncertainty takes over, people sell, causing prices to fall. Diversification, the golden rule of risk management. Putting all your eggs in one basket is rarely a good idea, especially in investing. Diversification means spreading your investments across different types of assets. This helps lower your overall risk. If one investment performs poorly, others might do well, balancing out your portfolio. Here's how beginners can diversify. Invest across different companies and industries. Don't just buy stocks in one sector, like technology. Look at healthcare, consumer goods, or energy. Consider different asset classes. Beyond stocks, think about bonds, which are generally less risky, or real estate. Spread your investments geographically. While focusing on your home country is fine, consider international stocks for broader exposure. Use exchange-traded funds or mutual funds. These funds hold many different stocks or bonds, giving you instant diversification with a single purchase. Diversifying helps protect your money from sharp drops in any single investment. Risk and reward. Understanding the trade-off. Every investment comes with some level of risk. Risk simply means the chance that your investment might not perform as expected, or you could lose money. However, with risk comes the potential for reward or profit. It's a balance. Higher potential returns usually mean higher risk. Consider these common risks. Market risk. This is the risk that the overall stock market declines, affecting even good companies. Company-specific risk. This is the risk that a particular company performs poorly due to its own issues, like bad management or competition. A stock with a history of big price swings is often considered higher risk but might also offer larger potential gains. A stable, well-established company might offer lower risk but also more modest returns. Before investing, always think about how much risk you are comfortable taking. Long-term versus short-term investing, setting your investment horizon. When you start investing, you need to decide your time frame. Will you hold investments for a long time or try to profit from quick price changes? Short-term investing or trading. This involves buying and selling investments quickly, hoping to profit from small price movements. It often means more frequent transactions and can be very challenging, even for experienced investors. This approach comes with higher costs and higher stress. Long-term investing. This strategy involves buying quality assets and holding onto them for many years, often 5, 10, or even more. The goal is to allow your investments to grow over time, benefiting from compounding. Compounding means your earnings also start to earn returns, creating a snowball effect over the years. For beginners, a long-term approach is generally recommended. It helps you ride out market ups and downs without reacting to every small change. Compounding can be incredibly powerful, turning modest initial investments into significant wealth over decades. Think about it. Steady growth over time can build a strong financial future, rather than chasing quick gains that might not happen. Getting started with investing. Practical steps for newbies. Ready to dive into the world of investing? It's less complicated than you might think. By taking a few practical steps, you can set yourself up for success and begin building your financial future. This section will guide you through defining your goals, picking the right accounts, and making your very first investment. Choosing the right investment account, brokerage versus retirement accounts. The next step is deciding where to hold your investments. Different accounts offer various benefits, especially concerning taxes. Knowing their differences helps you pick the best fit for your goals. Choosing between these depends on your income, age, and when you anticipate needing the money. Many people use a mix of both taxable and retirement accounts. We've covered what the stock market is and why investing can be a game changer for your financial future. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.